Hey everyone, welcome to this explainer. We hear a ton of buzzwords thrown around when it comes to digital assets, right? But today, we're actually going to cut through all that noise. We're looking at the massive, undeniable potential and, frankly, the harsh reality check behind putting traditional stocks and bonds on the blockchain. So let's just dive right in and find out what actually happens when the rubber meets the road in tokenized markets. Okay, picture this. It's 3 a.m. on a Sunday. Maybe you just can't sleep, and you suddenly decide, you know what? I absolutely need to buy shares with a blue chip company right now, or maybe a government bond. In the normal world, you'd be stuck. You'd be staring at a frozen screen, just waiting around for the opening bell on Monday morning. But what if you literally didn't have to wait? What if you could execute that exact trade instantly, dead in the middle of the night on a weekend? Well, that right there is the ultimate expectation, and really the core promise of tokenized markets. It completely turns our traditional concept of market hours totally on its head. Now, since you follow this space, you probably already know the basic premise here, taking a real-world asset and securely representing its ownership on a blockchain. But what's super fascinating to watch right now is how the actual underlying structure is taking shape. It generally goes down in one of two ways. Either the issuer of the stock or bond directly creates a digital security right from the get-go, or a traditional custodian locks the actual traditional asset in a vault somewhere and issues a digital token representing a claim to it. And the reason this is so crucial, because these tokenized structures can still pack all the standard legal rights you'd expect. We're talking voting rights, dividends, the whole shebang when it comes to clear legal ownership. I know, it's really easy to write this off as just another wild pitch from some flashy crypto startup. But the reality on the ground, it's much, much different. It's actually traditional financial institutions that are doing the heavy lifting right now. We are talking about major stock exchanges, global banks, heavyweight custodians, and massive asset managers. They're all actively teaming up with blockchain companies. Their ultimate goal is to figure out exactly how blockchain can become a fundamental layer of our financial market infrastructure, basically making assets way easier to transfer, settle, and access across global markets. And when you stack up the traditional way of doing things against this new tokenized vision, the contrast is just wow, it's stark. Today, a single trade has to crawl through this highly complex, high-friction network. It bounces from the investor, over to the broker, to the exchange, through the clearinghouse, into the custodian, and finally reaches settlement. That is a lot of friction. The tokenized approach radically simplifies that financial plumbing. It aims to smash trading, ownership records, and settlement together into a seamless digital process. Literally just a wallet, a trading interface, the blockchain, and boom, instant settlement. So this streamlined plumbing leads us to one of the absolute most powerful concepts in modern finance. The simple fact that the blockchain does not sleep. Think about an investor sitting over in Asia. Because the blockchain doesn't care if it's the weekend and it definitely doesn't observe national holidays, that investor could effortlessly trade a tokenized U.S. security right in the middle of their Tuesday afternoon, even while the traditional U.S. market is completely fast asleep. It creates this continuous, always-on global environment that completely redefines when, and honestly how, we interact with our investments. And it's this continuous environment that unlocks the four massive benefits currently driving all this institutional hype. First up, global access across all time zones. Second, much faster integrated digital settlement because, well, you're cutting out all those traditional middlemen. Third is fractional ownership. Since it's entirely digital, it's incredibly easy to chop an asset into tiny pieces, which lets everyday investors buy fractions of otherwise super expensive assets. And fourth, which I think is perhaps the most exciting, is programmability. Just imagine a tokenized bond that uses a smart contract to automatically drop your interest payment into your account exactly on time without a single human lifting a finger. But hold on, because here is the absolute biggest misconception about this entire space, and we really need a reality check here. Tokenization does not automatically equal liquidity. Let me say that again. Just because you take a traditional asset and slap it on a blockchain, it absolutely does not mean buyers and sellers are going to just magically appear out of thin air. The tech works beautifully to create the token, sure, but a token sitting on a blockchain without an active market of people who actually want to trade it, yeah, that's basically just a highly advanced digital paperweight. Let's slow down for a second and really chew on this. You could literally tokenize $1 billion worth of prime real estate or blue chip company stock. The token officially exists. The blockchain is humming along perfectly. But if only a tiny handful of people actually want to buy or sell it, that market is still highly illiquid. See, true liquidity isn't just a technology problem. It depends on a massive living ecosystem. You need eager buyers, willing sellers, market makers throwing down capital, robust trading venues, clear regulatory access, rock-solid custody, and interoperability between different systems. It literally takes a whole financial village. Which brings us to a vital distinction you absolutely have to keep in mind. 24/7 market access is not the same thing as 24/7 deep liquidity. They are entirely different beasts. Let's go back to our 3 a.m. Sunday scenario for a second. Yes, the market is technically open because the blockchain is running. You have your 24/7 access. But at 3 a.m. on a Sunday, traditional market makers are likely fast asleep. There are way fewer buyers and sellers online, and because of that lack of deep liquidity, the spread, the gap between the buying price and the selling price, could widen massively. So sure, the market is open, but the actual conditions for trading, they might be absolutely terrible depending on the time of day. And that, right there, is exactly why traditional exchanges aren't going anywhere anytime soon. Blockchain completely overhauls the underlying technology, absolutely. But it doesn't, and honestly can't, automatically replace the legal and regulatory systems we all rely on. A traditional stock exchange provides way more than just a matching engine for buyers and sellers. They provide the critical framework for investor protection, market surveillance, and handling complex corporate actions like dividends and shareholder voting. Trying to code all of that inherent regulatory trust into a basic token, that is an incredibly complex hurdle to jump. So, because of those hurdles, we really aren't heading toward this epic war of traditional finance versus crypto. Instead, what we're looking at is a hybrid financial future. We aren't going to wake up tomorrow and see every stock in the world suddenly moved entirely to a public crypto blockchain. What's way more likely is that traditional institutions, global banks, and regulators are going to maintain their vital protective roles while quietly utilizing blockchain as this invisible, highly efficient engine purring underneath the market. Essentially, traditional and tokenized assets will just exist side by side. Make no mistake, though, what we are witnessing right now is absolutely monumental. A lot of industry experts are calling this the single biggest change in financial infrastructure since the massive shift to electronic trading decades ago. But the big takeaway here? The real revolution isn't just the novelty of putting a stock on a blockchain. The actual game changer is securely connecting ownership, trading, settlement, payments, and global access into one unified, seamless digital financial system. That's the real holy grail. The technology is evolving at breakneck speed. But as we've explored in this explainer, the true hurdles aren't actually technological at all. The real challenges are building deep liquidity, ensuring these systems can talk to each other, and navigating a maze of global regulation. So, as we watch this financial landscape shift beneath our feet, the question is no longer, can stocks be tokenized? We already know they can be. The real question I want to leave you with today is this: can tokenized markets overcome these massive hurdles to become deep, liquid, universally trusted, and truly global? Thanks so much for joining me, and definitely keep an eye on those markets.